This is Cash Flow Questions, Understanding Cash Flow Analysis. My name is Jeffrey Smith. Objectives. Know how to calculate the capitalization rate according to the cost and structure of your available financing. Know how to calculate your gross return on equity, which is also called the cash-on-cash return. Learn alternative financing structures for a nothing-down deal. Calculating cap rate. Annual interest rate 7%. Amortization periods 300 months, that's 25 years. Loan-to-value ratio 75%. Debt coverage ratio 1.25. What is the capitalization rate? What is the gross return on equity, also called the cash-on-cash return? Income and expense schedule is not needed to answer these questions. Critical equations. Weighted average capital cost. Capitalization rate, CAP, equals net operating income divided by capitalized property value. Weighted average method. Capitalization rate equals annual debt constant times loan-to-value ratio plus return on equity times equity-to-value ratio. Debt present value equals capitalized property value times loan-to-value rate. Equity equals capitalized property value times equity-to-value rate. Annual debt constant equals annual debt service divided by debt present value. Return on equity equals net cash flow divided by equity. Net operating income equals annual debt service plus net cash flow. CAP equals NOI over CPV equals ADC times LTV plus ROE times ETV. Expand the annual debt constant. Expand return on equity. Expand debt present value. Expand equity. We see that the LTV is on top and bottom and the ETV is on top and bottom, so they cancel out, leaving just annual debt service plus net cash flow over CPV, which is identical to net operating income over CPV. Debt coverage method. Capitalization rate, NOI divided by CPV. The debt coverage method, cap rate equals debt coverage ratio times annual debt constant times loan-to-value ratio. We've already shown the weighted average method. Leverage to debt is the LTV divided by ETV. Return on equity is the quantity debt coverage ratio minus 1 times annual debt constant times leverage to debt. Cap rate equals net operating income divided by capitalized property value equals debt coverage ratio times annual debt constant times loan-to-value ratio. Expanding the variables, debt coverage ratio is NOI over annual debt service. Annual debt constant is annual debt service over debt present value. Loan-to-value ratio is debt present value over capitalized property value. We see that the annual debt service is on top and bottom. We see the debt present value is on top and bottom, so they cancel out, leaving just NOI over CPV. Now we know that the cap rate is equal to the weighted average. We also know that the cap rate is equal to the debt coverage method, so we substitute. Subtract the common term, ADC times LTV. Factor it. Divide both sides by ETV. And then substitute leverage to debt ratio for the LTV divided by ETV. And thus we've derived return on equity equals the quantity debt coverage ratio minus 1 times annual debt constant times leverage to debt. Calculating cap rate. We go back to the previous example, annual interest rate 7%, amortization periods 300, that's 25 years, loan-to-value ratio 75%, debt coverage ratio 1.25. What is the capitalization rate? What is the gross return on equity, also called the cash-on-cash return? First, we calculate the annual debt constant, 8.48%. That is equal to this equation. It is the number of periodic payments per year, which is 12 in this case, times the periodic payment. The periodic payment is calculated by this function in your financial calculator or your spreadsheet. We take the annual interest rate and divide by the number of payments per year. We plug in the number of amortization periods, plug in the negative present value of $1 and the future value 0. This is fully amortizing. The entire expression calculates the annual debt constant of 8.48%. We then calculate the capitalization rate, 8.12% equals the debt coverage ratio, 1.25, times the annual debt constant, 8.48%, times the loan-to-value ratio, 75%. The return on equity, 7.05%, equals the quantity debt coverage ratio minus 1, 0.25, times the annual debt constant, times the leverage to debt. In this case, it's 3. That's 75% divided by 25%. You'll also see here that the return on equity is less than the capitalization rate. This is a negative leverage transaction. That's because the debt coverage ratio is too low. You'd be better off just paying all cash with your equity funds, buying a smaller property, and getting 8.12% cap rate. Hypothetical scenario. A motivated seller is offering a free and clear apartment building and inviting all offers that provide at least $250,000 cash at closing, and he will carry back a note for the remainder of the purchase price at 8% annual interest, compounded and paid monthly, fully amortized over 10 years. The seller will pay all closing costs from the cash at closing. You know a lender that can provide a first mortgage loan under the terms specified earlier. Nothing down. For a nothing down deal, you want your total debt coverage ratio to be 1.50 with no cash out of your own pocket. Seller pays all closing costs. You will borrow your entire offered purchase price according to the parameters of the two financing tranches specified above. a first position mortgage loan, and a seller carry for the remainder of the purchase price. Actual income and expense. Gross scheduled income, vacancy and credit loss, actual rental income, other income, effective gross income, EGI, gross operating expense, GOE, net operating income, NOI. Financing structure. Primary financing. Annual interest rate 7%. Amortization periods 300. We calculate the blending of those two terms. The annual debt constant is 8.48%. Loan-to-value ratio 75%. Secondary financing. Annual interest rate 8%. Amortization periods 120. That's 10 years. Annual debt constant 14.56%. Loan-to-value ratio 25%. We blend these two financing tranches together with a debt coverage ratio of 1.50. Debt coverage margin is the reciprocal. Cash flow margin is the complement. Therefore, the annual debt constant is the weighted average of the annual debt constant of the primary and secondary tranches, equals 10%. The capitalization rate equals 15%, that's 1.50 debt coverage ratio, times 10% annual debt constant, times the combined loan-to-value. The return on equity is infinite because you have no net cash invested. Financial performance. Start with the net operating income, subtract the annual debt service. Your net cash flow is $17,027. Monthly net cash flow. First position financing tranche debt present value at 75% LTV. Secondary financing tranche debt present value at 25% LTV. The capitalized property value. The first tranche monthly payment, second tranche monthly payment, total monthly payment. The break-even rate, this is the economic occupancy rate for a zero net cash flow. It is equal to the sum of the gross operating expense plus the annual debt service, all divided by the gross scheduled income. When the economic occupancy rate falls below this percentage, you'll have a negative net cash flow. Alternative financing structure. Ask seller to refinance the property according to the primary debt parameters, then take title subject to that existing debt for non-recourse financing. Instead of a junior note and lien, give the seller a non-voting preferred equity membership in the new limited liability company that receives title to the property. Or bring in senior equity and preferred equity private financiers under the same parameters as the first and second tranches and pay all cash to the seller. Future pro-forma. If you improve the management, increase the gross scheduled income by 20% with vacancy rate 9%, and change the gross operating expense to 40% of effective gross income, then what would be the new debt coverage ratio? What would be your new net cash flow per year? If you sold the improved property after 1 year, to a buyer with a new first mortgage at 75% loan-to-value, 7% annual interest compounded and paid monthly, fully amortized over 25 years, and debt coverage ratio 1.50, then what would be the amount of your gross sale profit? If you refinanced instead of selling the property, then what would be your tax-free cash out? Pro forma income and expense. Gross scheduled income increased 20%. Vacancy and credit loss at 9%. Actual rental income. Other income. Effective gross income. Gross operating expense at 40% of effective gross income. Net operating income. Annual debt service. Net cash flow. Monthly net cash flow. Debt coverage ratio is now 2.31. Pro forma sale profit. Annual interest rate, amortization periods, annual debt constant, loan-to-value ratio, debt coverage ratio 1.50, cap rate 9.54%, return on equity 12.72%, net operating income, capitalized property value, first tranche future value, second tranche future value, gross sale profit. Not bad for a nothing down deal. Pro forma refinance profit. Annual interest rate, amortization periods, annual debt constant, loan-to-value ratio, debt coverage ratio. Same cap rate, same return on equity, net operating income, capitalized property value, refinancing debt present value at 75% of the new capitalized property value, subtract the existing debt first tranche and second tranche, your gross refinance profit. You still own the property with net cash flow, no net cash invested. Your cash out is tax-free, which you can roll into the next property. This is how you grow your wealth. This return on equity is merely academic because you have no net cash invested, and therefore your return on equity is still infinite. Income analysis summary. This is a simple one-page spreadsheet. The yellow cells are input fields. The other cells are output fields. You can analyze any deal that comes across your desk in about 5 minutes. You just plug in the actual income and expense in the left-hand column, the debt analysis of your available financing structure. You can include equity leverage calculations below for the secondary financing. You can then include the equity calculated bid to calculate the purchase price required to achieve 100% financing with the specified debt coverage ratio. The pro forma calculations on the right-hand side are for the improved property in the future. You specify the anticipated new gross scheduled income, vacancy and credit loss, other income, and the gross operation expense. The anticipated refinance or resale parameters for the first position debt and the debt coverage ratio. The spreadsheet calculates your profit for sale, your profit for refinance cash out. I include this spreadsheet in all of my real estate courses. This has been Cash Flow Questions, Understanding Cash Flow Analysis. My name is Jeffrey Smith, and thank you for your support.